Danny Agresta, President and CEO of APC Towers, mid-sized developer. We acquire and build sites around the country. We're approximately in 14 states. Prior to this, I was in the public sector for almost 18 years, starting off with Bob Crown, before Crown Castle, then Spectre Site, and American Tower.
Hi, my name's Neil Seidman with SBA Communications Corporation. I'm sitting in for Larry Harris. I was going to say I'm Larry Harris, and I grew a foot and gained 100 pounds since the last time you saw me, but I don't know how many people here know Larry.
And more hair.
And more hair. I'm the Senior Vice President of M&A at SBA. I've been in the business for about 18 years. I started when Ron was at SBA, and we've been involved in about 800 transactions over the last 18 years, and we just basically go around the U.S., Central America, South America, and Canada buying up tower sites. So, thank you.
And I'm Jason Nicolay, sitting in for Clayton Funk. So I'm the younger, better-looking version of him. We're with Media Venture Partners. We're a boutique investment bank focused on telecom. 18-year history in the telecom space, done 150 transactions in towers, and quite a bit of spectrum and wireless work as well. So,
Great. Well, we've got a pretty M&A-centric group up here with the exception of Danny and perhaps myself. So to the extent that we get a lot of those types of BTS questions and more operational stuff, Danny and I will try to share it. Now, we're going to try something different today. I'm not sure it'll work, and if it doesn't, we have a backup plan. But we thought that maybe rather than us pontificating about the industry and telling you what we think and what we think is important, perhaps the audience could start us off and ask questions and make this a bit more of a free-for-all, open-ended. So I'm going to try that, and if I have to, I'll go to the notes.
Or they can ask topics that they want to discuss.
Yeah, topics as well. So it's not going to work. Okay.
Looks like we can have lunch.
Yeah, and the crickets chirp. And whose idea was it to feed them while we're talking? So, look, I don't think I remember a time in wireless that's been like the last couple of years. I mean, virtually every key metric in the industry is off the charts. Everybody's floating very high on this tide. So it makes you ask a lot of questions. And I think first and foremost, one of the topics I'd like to introduce to the panelists and to the audience is carrier activity. You know, it's been very, very good for a number of years, but it feels like there's a bit of a change occurring out there, especially with respect to each individual carrier. So, Danny, I am going to lead off with you, and I'd like to get your perspective, and so with the audience, on how you see carrier activity. You can take them all, or you can take them one at a time.
Now, I'll start with the visual that Mark put up a couple minutes ago regarding the CapEx spending with the four majors. With Verizon, we've seen the most activity regionally based, and the same with T-Mobile. It was good news to hear that in the press release from Verizon that it was up to, what, $16 or $18 billion that they're going to spend this year. And T-Mobile's been active now that they're finishing up their 1900 overlay or their LTE, and now they're going to be working on ramping up the 700 megahertz markets. They've been pretty active. AT&T, you know, it was interesting to hear that it might be back-ended for 2015 because it's surely not front-ended, I can tell you that. It's been pretty slow across the board with AT&T, specifically going into 2014. And from all the analyst reports I've read, it looks like they may be building less than 2,000 less sites than they did in 2014. So again, it's good news to hear that they might come back with a vengeance in the second half of the year, which is great. And then Sprint, you know, if there's a hockey stick this year, it's going to be with Sprint. It looks like that they coming out with 3,000 to 5,000 rings to be determined. I think there's an RFP out there now for OEMs and services. So that'd be soon to follow. So all good news. Back in at AT&T, we're seeing Verizon, we're seeing T-Mobile, and then, you know, Sprint coming here soon.
And just to add to that too is, you know, as Mark Ganzi had mentioned too, it's the first time in 15, 18 years that all four carriers are going to be actually spending money, significant money in 1 year. So that's great news for all of us.
So,
Yeah, and Ron, on the M&A side of things, when we, I haven't seen this before, but recently we've seen a lot of it where individuals are in the market to sell their tower sites, and we reach agreement with them and start the due diligence process, and then right before closing, it turns out that the carrier who had committed to the site put it on hold.
Right.
We're running into that a lot right now with AT&T, where we thought we had an acquisition done, but the carriers pushed it off for a year or two.
So how do you deal with it?
Well, unless we're pretty certain that the carrier really, really needs the site, for the most part, we'll let the seller hold on to the site until the time comes that the carrier really is going to commit to the site.
Are you seeing, Jason, are you seeing any valuation fluctuations in the M&A market as a result of this activity?
You know, the market given the amount of activity, last year we saw AT&T was really prolific on the spending, you know, between their acquisitions of Spectrum, DirecTV, 2 acquisitions of Mexico, and everything else they spent for their wireless domestically. There's a lot of certainty around their growth. So valuations and the number of buyers out there between SBA, Tarpon, Mark, wherever he's sitting, and there's a frothy buyer market, and there's not enough inventory to keep everybody full and happy. So as a result, valuations have definitely increased. And as long as there's activity happening too, additional amendment activity and modifications, that's going to benefit the buyers in the end of the day. And so they're paying up a lot of that for that blue sky that hasn't hit yet.
Great. Before we move on to the next topic, does anybody have any questions for any of these folks with respect to carrier spend, carrier activity?
Bueller.
Oh, we got one.
Oh, boy.
So if I can repeat, the question was, what effect net neutrality will have on the industry? Anybody want to take that one?
Not my area of expertise.
I'll take a little stab. I'm not great at this. I've read a couple research reports. I think the biggest question right now is how it's going to impact everybody. I think everybody's sat down. There's a 400-page document that came out, I think last week or the week before. I think a lot of people are still trying to digest what that really means. And I think a lot of people have already said it's a lot of the same of what is already out there. It's just kind of making a general definition. And the biggest question is there's going to be a lot of lawsuits. So I think there's going to be money to be had, probably in this room. You got to figure out where to play it. And it's going to take a while to figure out what it really means, though.
I'm not sure any of us can actually add anything further. Great. Any other questions on the carrier side? Great. Okay. Build-to-suits. The industry has sort of grew from its roots using a build-to-suit model. Feels to me, and I'd be interested to hear what these guys think, that it's a big boy environment. Seems like the large public tower companies, or maybe with the exception of my friend Neil here, are trying to lock up more and more of the build-to-suits before it leaks out to the small ball players, as I sort of call us. Guys, feel that way to you?
You know, a lot of the clients that we're working with throughout the country are still getting kind of that 4 to 5, 8, 10 build-to-suit opportunities in different parts of the country. So, you know, I think that the publics are definitely trying to lock up a lot of the national build-to-suits. I think on a local level, there's still a lot of rings being traded around, or at least opportunity locally or regionally for the developers.
It's right up your street.
Yeah, I'll add a different flavor to that a little bit, and I'm not saying that I'm totally right, but there are 2 of the 3 publics which have been very active in the build-to-suit arena, and you can read that in the reports. But if you look back at the last 2 large tower or carrier tower acquisitions by the publics, there really wasn't a build-to-suit component to it. I mean, I think in the Verizon one, obviously I can't speak to details, but there was probably a whip that was attached to it, or a pipeline attached to it. But in the last 2, between the 2 publics that acquired, one AT&T and one Verizon, there really wasn't a build-to-suit component to it. So I'm not saying that there's a shift, but I am saying there is a lot of opportunity for the rise of the mid-sized developers. I'm more worried about competing with Ron than I'm worried about competing with American, to be honest with you. They're going to get what they're going to get. But I think between the Rons, the Joes, the Kathys, the Barbs, the Sues of the world that have these towers that are anywhere from 50 to 150 towers, that's who our competitors are with. And that's a good thing. It's as I said last year, it's a big backyard. I think we all just want a piece of it.
Yeah, I mean, at SBA, we will build as many sites as we can afford to build if they were the right sites. So we have a pretty stringent underwriting process for build-to-suit towers, and we have a gentleman named Mark Sharfello who leads up that department. And he'll build 200 sites in any given year, so a pretty small number given the size that SBA is. We are seeing, though, that on the M&A side, we do have a lot of folks coming to us saying that they did get 8, 10 sites as a contract, and are we interested in actually helping them fund those or build those? So I know that we are pretty selective on our internal sites and selective as it comes to gentlemen or ladies coming to us with sites for sale, but we're seeing a pretty decent flow of tower sites, better than last year, that's for sure, on the build-to-suit side. But we're seeing it at the local level quite a bit.
Yeah, I would echo probably everybody's comments on that. It's definitely been a lot more market specific. So, whether it's Verizon or AT&T, they're definitely empowering their local markets to decide what they want to do, whether that is build with a public company such as Neil's, or work with a local developer that has the zoning relationships and is able to kind of push a site through. And we're hearing, depending on who the carrier is and their ability to perform, anywhere from 5 to 20 sites from various places and various markets. But it definitely feels like it's the winds are starting to get behind people's backs from a local development standpoint to build sites more and more versus it going just to the publics.
Yeah, and I mean, the way the build-to-suit contracts come out, they could potentially damage a valuation of a tower site. So as local carriers look at their opportunities and they're not long-term holders of the sites, there are times when carriers will ask for certain terms of a build-to-suit contract that when we eventually get into the valuation of that tower site, it's going to significantly affect how much we think it's worth in the public markets. All the acquirers of towers look at tower sites differently, perhaps. There are some generalities that come into play, but for the most part, we all are guessing a little bit on what the future growth is of those sites, but the terms of those build-to-suit contracts are extremely important to preserve the value of your sites going forward.
Let me ask, I don't know if you guys can answer this question. I mean, do you see the build-to-suits and just the build opportunities in general being more traditional infill type sites, or they're tertiary markets? Is this sort of, I've seen some stuff that looks like it's LTE only. I mean, anybody have a perspective on that?
It seems like we've seen a lot of infill and tertiary with some of the smaller developers.
Same, yeah, I mean, it's a mixed bag.
Yeah, I mean, when we go to buy sites, obviously we want the best carrier in the best market to be able to create that growth. We're seeing also carriers getting a little bit further out, and so it's a little bit harder to justify certain valuations, Ron, as it relates to some of the tertiary markets that are being built out right now.
Yeah, there's definitely, for certain carriers, the big two, particularly AT&T and Verizon, a lot of coverage and capacity sites to offload traffic. But I think one of the interesting things right now is T-Mobile has been active in buying 700 megahertz A block to really expand its footprint. And so the interesting thing about that is we're seeing them stretch their footprint so they're no longer roaming on AT&T. So that's expanding, going outside of the suburban and ex-urban markets, and kind of a new build in some of these more rural parts that we hadn't seen in a while. And that's becoming more active for certain carriers. And Sprint will need that at some point to expand its footprint in those areas as well.
Interesting comment. It makes me think about the type of spectrum that both Sprint and T-Mobile have, because it seems that everyone in this room and even the big guys are going to depend much more on them this year for growth, with AT&T largely being on the sideline. So as you think about the type of spectrum, the high frequency spectrum that they have, and the fact that they're behind relative to Verizon and AT&T, does it make the siting decision a hell of a lot different, right? Is there more risk in siting build-to-suits for those two as compared to the first two, as compared to AT&T and Verizon? What do you think?
Go ahead.
I think from AT&T and Verizon standpoint, they've had low-band spectrum, cellular spectrum for 25 plus years. They have the incumbent network and have perfected those networks. A lot of those networks are now being shifted from 2G to 3G and now the LTE. Sprint has 2.5 and a lot of mid-band spectrum, so they have a lot of high frequency, which for them is a disadvantage to be able to get a lot of coverage. So, they're going to have shorter hops between a lot of their sites because they have a lot of capacity. They can you can watch your video, it's going to come down a lot faster, but they need a lot more sites to be able to have the same quality of service that they want for their customers. With T-Mobile, the A block was a pretty big transition for them because it allowed them all of a sudden not to be focused exclusively with AWS and PCS spectrum, but now they have low band spectrum, which if you understand propagation, which a lot of the people in this room will, because you got to get that broad coverage, and right now they're relying on these little networks and nodes to help that. And all of a sudden now they can boost 25 miles out with this A block and get coverage and reduce roaming from AT&T. So long term, I think their values are going to hold because they're going to be able to cut their expenses that they're paying to AT&T and be able to afford those sites. So it's going to be important for them to expand and do that as they can and buy those A block licenses.
Danny, anything to add?
I think they covered.
Nope.
No.
We don't have to kick it. We can move on. Okay. I think next I'd like to talk about the small tower industry, the small tower owner industry. It feels like everybody and their mother is in the tower business these days. In a lot of ways, it seems as though financing is readily available, both on a debt and equity basis. Many people being financed by private equity. We're now seeing the advent of maybe family offices getting into the business. Can this be supported? Is there enough flow and opportunity for all of us, all these folks, to be in the tower business? Keith.
Yeah, I think there's a ton of opportunity. There's a lot of development opportunity. A lot of our clients are self-funded. So what they're doing is they're building some towers, holding them for a period of time, and then selling off the assets to help fund their next batch of assets. I think there's less kind of traditional private equity funding tower companies today because a lot of the middle market's already been consolidated. But then Peppertree probably has 20+ portfolio companies as well.
Yeah, I think what's happening, Ron, is the tower companies are getting involved earlier and earlier rather than, we've seen private equity fund folks for a long period of time. And, when you go with private equity, as most people know in the room, you give away a big chunk of your equity in connection with the valuations. In an effort to create deal flow, we've started getting more involved on the front end, and we've been offering, no equity financing for tower developers in an effort to get a big backlog, and that seems to have worked for us. People out there, you're right, there's a ton of money chasing towers. It's really the question is what's the cost of those funds? And so we've been very successful at SBA in getting in the front door very early with folks, telling them we'll finance their tower builds and we'll buy them at the end of the day. And that's creating extra deal flow for us. Several years ago, we started getting very nervous. Actually, for 20 years, we've been nervous about what's around the corner and is there going to be deal flow. We didn't realize this year is actually turning out to be a nice year for deal flow. But if you would have asked me this question last year in December, I would have been really nervous, saying I think I may be out of a job soon. So I think there is opportunity out there, and I think there are deals out there, and I think there are people building towers out there. The cost of building towers is coming down, which enables people to take additional risk associated with building sites that they may otherwise not if they were giving away a big chunk of their equity / financing costs. And so we think the market's competitive, but that there's still good opportunities out there.
So I wrote this down earlier. We shouldn't be nervous at all because Gansey said 80,000 new sites by 2019. I wrote that down, so we're good. Everyone should be good. But no, in all seriousness, if you think about, just go back 2 years, there's always been developers, right? Self-funded private equity, but there's been a shift sort of in the last 2 years. There have been executives like me who've been around for 18 years or so, a bunch of us that wanted to try something different, so we came out trying to get into the build-to-suit market. And then one of the largest non-public tower operators sold, and there's a half a dozen executives that spun off from there. So there's this whole influx of those that were in the tower business but now on their own. It's more crowded than it's ever been. I mean, it's more competitive than it's ever been. But it was a perfect storm because you had that and you had a ton of money sitting on the sidelines, a lot. And true or not true, they were seasoned and proven, so it was easy to raise money. So again, it's a big backyard. There's more competitors. I think the tower developers have changed, and that's why you see an influx the last 2 years more so in the last 10.
Right, but there's still there's still a small middle market, so there's a lot of smaller operators. So it's probably more competitive that way.
Yeah.
I know Clayton would say if he were up here that 18 years ago when he started the business, started selling towers, and he got a phone book. I think it was the Friars Guide. He would open it up, started making phone calls, and he told his boss, "Look, it's going to be 2 years. I'm going to be out of a job because there's no more towers." Fast forward, we're all still here, and there's really no end in sight. I think if I would imagine if everybody were to raise their hand and say they have a smartphone, I would wonder who doesn't have their hand raised and why they're using a flip phone, because no one here in this room is probably doing that. And the amount of data that we're using is only going to continue to densify the network. So I agree with Mark. I mean, is the number 80,000 new sites by 2019? It's definitely, it's going to continue to accelerate. And the additional spectrum that all the carriers are buying is going to help drive a lot of that new development as well over the years. So I don't see any near-term end of development stopping.
Anyone else? Great. I think that's a nice segue into the current state of the M&A market. Leave the larger transactions aside. Multiples, all-time highs. I
Yeah,
remember.
The multiples are way up there. I mean, everybody knows it's a real estate business, and real estate is cyclical. But we've seen multiples come and go over the years, Ron.
Yes.
I would have to say
Go
that
on,
they
Ray.
are probably the highest we've ever seen. My hope as a buyer of towers is that settles down a little bit. And
No.
comes back a little bit to something that works a little bit better. But
What's driving? What do you think?
It's market pricing.
It's supply and demand. It's several things. First of all, everybody's cost of capital has come down on the public side. I mean, many years ago, Ron, in 1997, I think SBA's cost of capital was some ridiculous number, 15%.
High
So
yield.
it's hard to make a financial model work when you're paying 15% on your money, and so we're down, much lower than that, and so we're able to pay more for our assets. The problem is supply and demand. There's some pretty big tower companies out there, and used to be, if you bought a 100-tower portfolio, that was pretty significant. It's significant, but it's not as significant as it was. So everybody's out there trying to buy towers. We all have better visibility. Our deals are loss leaders. I mean, if we were to buy a tower at 25 times and it never grew, that's a disaster. We have a lot more intelligence as to what works and what doesn't. So many years ago, naked towers were getting built all over the country, Ron, as you know, and those were
Had to make your numbers, Neil.
Yeah, you had to make your numbers. But it was a disaster. Now we can look at a particular tower site and say, you know what? Even at 20-something times, that still works because we know that this carrier's not there. We know this carrier's coming there. So I think actually, in addition to the increase in prices, that comes along with an increase in market intelligence, and those deals still work sometimes. American Tower may look at a portfolio and value it tremendously more than we do. They may know more about it than we do. They may have better access to numbers than we do. And so I think everybody's looking at deals differently, but you're right, prices are an all-time.
Is it?
But the driver is that the public stocks are at all-time highs too. So the public stocks, the public companies are all trading at all-time highs. So that's definitely flowed down to the private transactions as well. And there's a lot of money running around looking for deal flow.
Is it sustainable?
Yeah.
What causes an adjustment?
Here's my opinion.
We are going to start calling you Larry in a minute.
My opinion is the adjustment comes from mistakes that developers start making in the industry. For example, we need to lease, when we wind up with a tower site at the end of the day, we need to lease out space to carriers to grow that portfolio. What you start seeing worse and worse and worse are the carriers having more leverage over the developers and getting more rights to equipment. Well, a lot of our success came from amendment revenue over the years. And as developers of the initial carrier, the anchor tenant, give away a lot of those future growth opportunities, that lowers the value of the tower site. And so I think what you're going to see, Ron, is as the carriers get more developers to do things that perhaps aren't the greatest long-term decision, it may actually affect the long-term value of a tower site.
I think, Danny, you wanted a piece of this?
I don't know about a piece, but
John?
sure, there have been concessions made, but that goes all the way up to the public. It's not only the tower developers. It goes all the way up to the public,
Sure.
to the largest companies in the sector. But at the same time, I think it goes back to you guys are trading at a all-time multiple, which makes it easier to buy. Your money's cheaper, and that creates an opportunity for acquisitions, and from one tower to 1,000 towers. and it fits in with your portfolio. And if the larger the company and the more they buy, if they make a mistake on 100 towers, it doesn't move a needle for you, for one of the larger companies. So
Keith, how much flow you think we have this year relative to last year? We're going to be up, down, flat?
I think it's going to be flat to up. I think there's a ton of deal flow. Already this year, we've had 7 deals priced out. I think last year we closed 11 transactions, so we've had 3 close already this year, 4 others priced out with signed purchase agreements.
Average size?
Average size,
Tower count.
about 12 or 13 towers, $10 million a deal, 1.5 tenants per tower on average, 28 times cash flow.
that's why you're
And
dressed so
about
nice.
$800,000.
Was that Neil?
About $800,000. Now
Larry.
that's not the value of every tower out there, but that's been our average that we've experienced this year on 7 deals.
Great.
Yeah, so from a different perspective, too, to talk about the frothiness of the market, I mean, the public markets are definitely helping prop up valuations for everybody, but as Neil was saying, right, it does really drive down to the fundamentals. If a tower is located in the wrong site, it's been around for, call it 8 years, 10 years, doesn't have lease up, or there's no capacity remaining for it, you're not going to see a 28 times multiple, right? You've kind of hit a max there in a ceiling. But that being said, there's so much demand for quality inventory and frankly just any inventory that prices are rising above the tide a lot of times because of that. I mean, for example, we're running, I think, probably 2 or 3 processes currently where it's not unheard of that we're getting 10 to 15 bids on an asset, right? And those offers are pretty tight. They're not somebody, there's not a lot of people kicking the tires down at the bottom. They're legitimate offers. So, whether it's the 3 publics or some private equity backed companies or even individual, mom and pops that have capital that are looking for a good opportunity, people are ready to spend some capital because they believe in the long-term value of these assets. And I think one thing that's unique around this particular piece of asset, which I think helps the valuations that we're seeing, is just a few years ago, right, we were in a dip in the market. The market went down. Everybody, the banks went sideways. Everybody was worried that the end was near. We all quickly saw that no one gave up their cell phones. You may have changed carriers, but guess what? Towers, they took a dip, but they went back pretty darn quick. And people became comfortable that it's not recession-proof, but it's definitely insulated from some of the issues, given the terms of the contracts, et cetera. So, I mean, as Neil's saying, I mean, really protect your contracts. That's really a lot of value in there.
Yeah, I mean, every day I come across a site, even on the ground lease side of things, you can really increase the value of your assets if you do things smart on the front end. Ground leases are so important now with all these people out there trying to buy out land on the towers. If you have a 15-year ground lease, you're not going to, at least not from us, you're not going to get a 28 times valuation. If you have a 75-year ground lease, it helps a lot. If you have a provision in your ground lease that says that the ground owner can force you to move the tower at any time and that's at your expense, you're not going to get a 28 times valuation. So really, it's a very simple business. If Larry can do it, anybody can do it. Wow.
I guess the question is going to be when the interest rates rise, right? I mean,
Yeah, that, obviously,
They-
cost of capital goes directly into our financial model. As our cost of capital goes up, the amount of money we can pay for tower assets goes down. We are in a very low interest rate environment. You don't have to tell anybody in this room that there's no place to put your money to make money right now. But you're right, as soon as those numbers
Right,
come
when
up.
public stocks start trending down, that's when private transactions will start trending down as well.
Yeah, I mean, what's interesting about the public multiple, though, is many years ago, every deal we did was accretive. So if we were trading at 15 times cash flow, we were doing deals in the 12 to 13 to 14 range. As a matter of fact, at the time of the collapse, I think one company was doing deals at the 10 times range. It's really interesting that all of a sudden our deals trade at above our public multiples.
But you're much more mature than a lot of the deals that are on the market. So
Okay,
you're buying your growth.
At this cost of capital, you can make anything accretive.
That might be true.
Yeah,
That might be
it is true, yeah. So let's move on, because I want to leave plenty of time for questions now that everybody's stuffed their faces for the last half hour. So auction's over. In 2006, $13.7 billion was spent on wireless spectrum. In 2008, 18.9, and just recently, 45 billion. It's a lot of money. It's real estate. It's real estate in the sky or in the airwaves. And each and every time each and every time there's been an auction, there's been a significant amount of investment in infrastructure and wireless. Love to have somebody start that off. Got a view? And when does it happen? Really, the timing is critical.
Yeah, I'll kick it off. We have a pretty large spectrum practice, so it's really interesting, right? Spectrum obviously drives lease-up activity that happens over time. The most recent auction, AWS-3, as Ron was mentioning, right, was $45 billion. It was anticipated that number was going to be 20 to 25 billion, so it went light years above where anybody thought it was going to go. It's going to be a while before that spectrum is put to use. It has some encumbrances right now. There's, AT&T's just spent $18 billion. They basically said, hey, we're also not going to go build out heavily this year and kind of preserving some of the cash. There's also another auction coming up, right? So you don't even look at what's necessarily happening, but the carriers don't have access to a ton of spectrum right now because the last auction that's on the docket right now is this incentive auction, 600 megahertz. It's going to be considered the kind of land, the beach property of spectrum. So anticipating $60 billion from that was the latest Greenhill report. And carriers are, they just spent $50 billion over that in the last couple years in spectrum. So anticipate them to go spend another $60 billion. It's going to be a while before they're going to have the capital to go spend that. But there's going to be a 5 to 10 year build out requirement, which will mean ad mods and a lot of activity. Now, one of the interesting things I'll just point out is that AT&T went really, really strong after this, spent $18 billion on spectrum. Verizon only spent 10. You may not say that's a lot of money, but that's a lot of money. And in terms of what they're spending. And one of the things they noted there was, hey, look, we didn't spend as much. We didn't think the pricing was as attractive as it should have been for spectrum. We're going to build more infrastructure. We think we can create the same network with more infrastructure, more towers, more cell sites that will compete as well as if we had as much spectrum. So I think some carriers, Verizon is saying, hey, look, let's build more infrastructure. We don't need to spend as much on spectrum. We can create a quality network. AT&T took a different approach. Let's spend $18 billion. We're still going to have build-out requirements associated with it, but we're more focused on our spectrum and capacity and building the pipe that way. So there's going to be build-out for all these spectrum licenses over the next 5 years and anticipate activity around a lot of that.
Yeah, I'll put a different hand on it as a developer. It's interesting, right? Big numbers, 45 billion, 1,600 licenses between the economic area and the cellular market area. But what does that mean to me? If you read through the AWS-3 report, it talk about operations. 40% of it doesn't have to be. You have to provide service and reliable network on 40% of your pops within 6 years, and 75% within 12. So, is it going to happen overnight? Probably not. Is it going to be chirp, chirp, chirp for a couple of years and then it happens? Probably so. There'll be a gradual, improvement. But again, does it happen in 2 years from now, or do they have to really wait for 3 or 4 years before they have 40% of the pops that they are under the qualifications?
Yeah, the U.S. still has slower LTE speeds than the rest of the world, so there's still a lot of work to be done.
Anyone else? So, one final, we're going to start with you, Keith. A couple things you're keeping your eye on for 2015 and beyond. They're important to you, or what you think is important to the industry?
Yeah, for me, I'm keeping my eye on the public stocks, making sure they're trading where they are, and also carrier spending. That's what's affecting my client base.
Mr. Agresta?
So keep my eye on guys like you, one, because we bump into each other in offices all over the country. Second is just the CapEx spending. Again, it's good to hear that all 4 carriers will be spending this year, and just getting a piece of that in each one of the markets that we operate in. But that's it. It's building relationships and building out our network, and we try to compete with acquisitions, but that's obviously tough.
I'm not going to repeat what they said, but something that I'm sort of interested in would be, and we can talk about this if you want after you guys are done, but what happens with Dish and what happens with Google, and what does that do for us as an industry? I think good things, but maybe we can talk about that subject after you guys go through your keeping your eye on comments.
Yeah, we're just making sure we're involved in every transaction that comes to market, Canada, U.S., South America, and Central America, making sure we maintain relationships with developers who build quality sites. And, if you've got a quality site, we're going to make sure we pay up for it this year and probably next year as well.
Yeah, I think interest rates will be interesting to watch. The Fed's always kind of hinted at stuff, but again, we haven't seen interest rates rise, so it'll be interesting to see how that plays out over the next several months and years. And then I think new entrants, as Ron was saying, not necessarily, Dish is all, Charlie Ergen's just a wild card. No one, he spent $10 billion and has a huge spectrum position. And, there's companies like Pacific Data Vision, the old Nextel founders that are starting a new round. I think there's some new entrants out there. And then what happens to FirstNet? It just got funded with part of that $45 billion is going to go to fund that. So there's new life potentially as new tenants may come up. So it'll be interesting to see how that plays out.
Anyone else want to chime in on Google or FirstNet, Dish?
I just think it will be good news if they partner up with a T-Mobile or a Sprint, because that will force them to build out the networks, because they're not going to want an inferior network competing against other carriers. So I think that's just all good news for the tower sector.
Yeah.
I thought of one more topic, and that's small cell. I don't do small cell as a tower owner. I've had a difficult time really finding the right business model that would work, that gives you the type of returns that our investors are looking for. I think it seems like a much more suited to the bigger players. You guys had, I think, a play sort of through DAS and small cell.
Yeah.
What's your feeling on small cell?
Well, I mean, we look at it all the time. We have an investment in a DAS company that we've had for a long time. As we wind up buying DAS assets over the years through bigger transactions, we've contributed them to, a DAS player and taken equity. So we have a position in that. We haven't made the leap strong into small cells yet, but we talk about it all the time. Almost every day, the words are mentioned, and we sit down and we talk about it. And when the right time comes, I believe SBA will jump in at what we believe is the right time.
Yeah, I know, small cells was definitely a buzzword for the last 3 to 5 years. That term's starting to become more real and what that's looking like. And I think for everybody in this room, everybody's interested in what neutral hosting small cell is, not just building, a node that only works for AT&T or a node that works for Sprint, and having something that you can actually monetize with all the carriers. And I think that realization's coming. There's Verizon's definitely leading the front on a lot of that, and AT&T is too. They're being progressive with a lot of that. So I think it's coming to realization here in the next few years.
Is there a little cottage industry like we have in towers? I mean, there's small guys out there trying to build.
No, not that we've seen.
No.
On the flip side, we're actually starting to see that in some of the stuff that some guys in particular. There's certain venues or buildings, right? It's not necessarily the municipalities aren't doing that. Macro cells tend to be where the game is, but there are certain, like I said, buildings. New York City probably has one of the most prolific DAS networks in the world, right? Not each building, but many of the really tall sky rises have their own DAS networks. AT&T had their own group, the ASG group, that went out to go build these networks to ensure that they could provide quality customer service for their customers that were on the 90th floor of some of these skyscrapers. Because when you go up on the tall building, those networks aren't pointing up in many cases, and they're not going all the way up the sky. They're pointing down to where the majority of the people are. So I think there will be, more and more developers looking at that, and we'll see some capital go in that, and we'll have not probably as big of an ecosystem as the tower space, because the capital checks are quite large. It's not $150,000 to $200,000 to go build a site. It's $2 to $5 million to go build a DAS network or a string of small cells. So
Yeah, I think everybody's still trying to figure it out, because it seems like a quantity play to make money.
Yep. Well, I was told to try to make it 45 minutes so that we had 15 to talk with all of you. So we are at that point in time, and we'd love to have questions from the audience.
Yes.
I'm interested if you're all seeing there seems to be a lot of pressure from carriers on the rental rates down, not up or down.
What's changed?
Verizon in particular, T-Mobile. What are you all seeing, and how are you expanding that?
Let me just repeat, because I'm not sure the rest of the room could hear that. The question was pressure on lease rates from the big carriers, pressure on terms of the agreements that they're signing with the tower companies. So Neil, you get to start.
All right, so you're right. I mean, there certainly is pressure, and as you get 10 developers in the local market, somebody may take a site and build a site for something that other people may not build a site for. And it's important because as a developer of tower sites, that does affect your valuation going forward. Assuming you're not a long-term holder of tower sites, the lower you build for, the less money you're going to make at the end of the day. Although I have seen some things go the other direction. I mean, really, this is real estate, and I've seen some numbers on leases that have frightened me. If you've got a site in an amazing location that nobody else has, the carrier's going to pay for it. And there have been times when I've looked at numbers on an acquisition and said, oh my goodness, we're going to get a phone call after we close this thing asking for the rent to go down. But really, it's a location play, and if you've got the right location and you're smart about it, you're going to get your number. But yes, there's definitely pressure to bring down rental rates, and there's more people willing to build for less money on any particular tower site that we're seeing.
Danny?
Historically speaking, when I started in 97 to today, the rental rate has been sort of flat. Same site, same place, same city, 97 today, the rent, give or takes a couple bucks here or there. What's changed it, I think, but definitely has changed it, is the amount of, and you mentioned earlier, is the amount of developers in that market. And there are developers that will make more of a concession than others. But, we've been through this phase before. We went through the frequency phase where, frequency restrictions was a bad word, and now it's loading. And so at the end of the day, the real pressure has really been on the escalation, and that's been publicly announced in the acquisitions. And so there's been a downward turn on that. But relatively speaking, there's pressure. There's always been. Rates are the same. The loading might be a little bit different than it looked in 97, obviously, but it's really been pressured a little bit on the escalation part in my practice.
Anyone else? Yeah, I'd add, you have two types of pricing pressure. You have pricing pressure at the build-to-suit level, where you're giving a preferred plan to the anchor tenant. And I think those have largely stayed in that $1,600 to $1,900 a month range. I think is probably fair. And that's really with the little guy. I think you have the take-or-pay type deals that the publics, some of them, not all of them, have cut, which makes it really interesting because it's kind of hard to understand what the true price is. And that typically is combined with a commitment to other sites moving forward. And then there's lease-up pricing. And that, at least for the small guy, I think has largely gone up because you have a lot of leverage when you're small. If you're willing to wait and you're patient, which you should be because you're not pressured by necessarily the public marketplace and quarterly results, you can wait. If you have that great site that Neil mentioned, you should wait because eventually they will pay. And I would add that today in the environment, I didn't get to see Mark's talk this morning, but I understand it was about this whole ecosystem of how wireless has evolved. Today, wireless has evolved to the point where we're no longer dealing with search rings per se. We're dealing with pinpoint accuracy in a lot of cases of where the site has to be, has a specific need. And because of that, it causes two problems. One is a scarcity value. There's only so much property that is zonable, right? And you have to have a piece of property that's actually large enough to accommodate it. So when you start getting into that environment, and if you're a builder of towers or you're buying towers that sit in these types of areas, you can wait, and then you therefore can drive up pressure. If you're large, you can be leveraged a bit by the carriers. You have very different needs than a small operator does. Other questions?
Can I eat?
Oh, yes. That's it. I think we're done. Thank you.
Thank you.
Thank you.